This is Satya Pratiman of Cirrus Research. The latest issue of the Signals Report is just out. The Signals Report is an asset allocation report that looks at various indicators such as risk-taking, market crowding, stocks versus bonds, growth versus value, etc. The title here, Buy the Dip, Resurfaces Crowding Sell Signal. This is a big deal. The crowding model that we use, the Cirrus Polarization Quotient, this looks at the multiples of momentum stocks. The bottom line is that these multiples at the end of January from the late fall rally, what we ended up getting was a very crowded market. The largest leadership stocks were selling at multiples of well above the normal boundary. The correction into February, March allowed this indicator to come back down. And since then, this has re-escalated back up to a 76% premium. So moral story is that we do have a problem here that typically when the market gets to this sort of extreme, the reality is that trending factors tend to break down. The irony about this reading, though, I think the most dramatic thing I'm seeing here is that it's rare that you get a reading like this as we expect estimates to be shaved lower. So I think this is a big deal. And the fallout in February, March from the original reading was pretty powerful. I think this is something that we're going to take a lot more seriously. In terms of leadership, where are we at? No surprise, technology is the largest cluster. What is interesting, though, is the pullback in financials. The financial sector was also quite a component of the leadership basket. That is still here, but a much smaller proportion. Smaller caps look differently. Financials and healthcare are the leadership in smaller caps. We still have technology there, but it's nowhere near like the large cap market for the obvious AI reason. So this, I think, the allocation model that we run, stocks versus bonds, this is super interesting. The reading is now about a 66% equity allocation, a bit lower from recently. But this is still an overweight. And so the question is, what gives? Given our concern on leadership, what this is probably saying is that the amount of run-up does present some issues, but the potential inflationary sort of fallout from the tariff regime could end up becoming a more adverse scenario for fixed income. So I'm doing my best to sort of reconcile why you would get the still constructive read on the asset allocation to equities. A follow-through to this is that it's quite possible that we're in a rotational market. So even if we are correct and we do see some weaknesses, the reality is a good chunk of the rest of the system is fairly discounted and pricing in a slowdown. So this value-leaning oscillator is dramatic because in the last 20 years or so, we've only had 2 or 3 moments where this has gone to effectively an overweight value. So this idea about the markets becoming more valuation sensitive should play a role here if you end up getting some increased percentage of earnings estimates that get shaved. As a follow-through, and these two tend to go hand in hand, what we're also seeing, if we say the word broadening, you're also meaning that small caps are going to participate someday. And so given the fallout, there's a rush to liquidity right now that's been especially a penalty for smaller firms. We think that the sort of band is getting so stretched that tactically you probably see some support, but strategically, if you're moving to a world where valuations matter more, by definition, you're going to go into lower cap firms. So take a look at the full report. It's fairly dramatic, though, the concerns with crowding. And as always, happy to take your questions. Thank you.